Welcome to episode 3 of the Bites podcast. Thank you for all the wonderful comments left thus far on YouTube and elsewhere. I really appreciate it, and please do keep them coming. And of course, subscribe to the channel if you haven't done so already. I attended a very cool Capitec event this evening, so I've certainly got banks on the brain. And that's a good opportunity then to mention a story that came out recently, which I think deserves a little bit more attention. And that is a ratings upgrade from Fitch for several of our local banks. So that is ABSA, FirstRand, Investec, Nedbank, and Standard Bank. You'll notice Capitec missing from this list, but that's because Capitec was recently upgraded by S&P, which is really much the same thing. Now, before we talk about why this matters, I have to remind you that South Africa, on a sovereign level, still has a junk rating from Fitch. So we are clawing our way out of the dustbin, but we are still in it, unfortunately, after years and years of terrible policy here. So our sovereign debt was recently upgraded from BB- to BB with a stable outlook. So that's a good thing. We're starting to climb up the side of the dustbin here. Now, of course, that brings down the cost of borrowing for South Africa as a whole, and it makes our government debt higher quality. Now, what does that mean? It means there's a look-through benefit for our local banks, which hold a lot of South African government debt and, of course, have exposure to the economy as a whole. So if the whole place is looking better, then naturally the banks are looking better as well. And this is why Fitch has now taken the step to upgrade these banks. Here's the interesting thing. It's from AA+ to AAA. Now, you can't compare this directly to a AAA rating internationally because these ratings have got ZAF in brackets after them. So it's AAA ZAF. So what that means is by South African standards, this is AAA. You can be the best cricket player in your high school. Doesn't make you the best cricket player in the world. And in this case, the high school is South Africa. So by South African standards, these banks have basically top tier credit quality. Again, why should you care? Well, there are a couple of reasons. Number one, it tells you something about the health of our banking industry. South Africa may have a lot of problems, but our banking industry is not one of them. They are very well regulated, very well managed. Genuinely, we have world-class banks, and that comes through in the credit strength of these banks. Second thing to keep in mind is that credit quality defines the rate at which these banks can borrow money. Now, banks borrow money as literally the ordinary course of business. They are issuing paper in the market all the time. So their credit rating makes their debt more attractive for money market funds, international investors, all that kind of thing, looking to come and get some emerging market exposure. South Africa is well known for offering strong yield based on the risk that we actually have. That's why our bonds tend to be quite popular with international investors, and the same thing with our corporate paper. It's why we have this vibrant debt market in South Africa. It's quite an unseen market, actually, because we always just talk about shares and equities. But in reality, underneath that, there are billions upon billions upon billions of rands, trillions of rands, I'm sure, changing hands in the debt market, being issued all the time, etc. So this is important stuff. And if the cost of borrowing comes down, then guess what? They can lend out money at potentially a more competitive rate. That can reduce the cost of credit, in theory, for all South Africans over time. And that is why government must always be held accountable for the environment they are creating, not just for our banks, but also for our corporates. Because if companies have access to funding at a lower rate, then they are able to borrow money more cheaply and they can leverage up their returns for equity investors. That's why it's called financial leverage, because you're basically taking an operating profit growth rate and you are leveraging it up or down based on how much debt you have. That's maybe a broader topic for another day. But the thing to remember is that as credit ratings improve, cost of borrowing comes down. As cost of borrowing comes down, shareholders are better off. So that's a nice piece of good news here for our local banks. Now, from debt raising to equity raising, and Hyprop gave us a really good example of an accelerated book build in the past week. So initially, they announced that they would be looking for 500 million rand in fresh equity capital. And as I wrote at the time, there was a very good chance that it would be upsized based on demand. I wasn't wrong, as they ended up increasing this raise to 739 million rand, an extremely weird number that is driven by the maximum number of shares that the company can issue based on the current authorities they have in place from shareholders. So there was actually more demand even than this number, let alone the 500 million rand that they initially planned. So why was I so confident that they would upsize it? Well, that's simply because the equity capital pools on the JSE are very deep. There are numerous institutional investors who are interested in this space, investing on behalf of pensioners, for example. There are insurance companies who look at these assets. And the reason is very simple. I think there are really two reasons for it. One, these companies pay very dependable dividends. It's actually what they are forced to do by the REIT legislation. They're only allowed to hand on to a small proportion of their earnings every year. The rest needs to go out to shareholders. So investors feel confident that they will receive nice, juicy dividends over time. But of course, it's not just about receiving dividends over time, because those dividends need to grow. And that is where the REITs are particularly interesting. They enter into leases that have underlying escalations, like you would do if you were renting a house. There's going to be an escalation in your lease. Well, same story. If you are a shop, or you are renting a factory or a warehouse or even an office, there's going to be an escalation. And that escalation gives the investors in the REIT a lot of protection against inflation, actually. The REITs do a remarkable job of delivering returns in excess of inflation. Obviously not all of them, obviously not under any conditions. So for example, if interest rates have gone up a great deal, or we have an extreme event like COVID, then obviously all bets are off the table. Then anything of the sort of typical historical situations will not apply in a world where we have something like COVID. I mean, that's true for any sector. But under almost all other conditions, the REITs are pretty dependable sources of growing dividends. And this means that a company like Hyprop can wake up in the morning and say, well, we want 500 million. Obviously, it's not quite that simple. A lot of planning goes into these things. But by the next day, they will have locked it in. Their advisors will have picked up the phone, gotten hold of the institutions, locked in orders at a specific price. And you can actually see the level of demand come through in the pricing of this capital raise. At 58.50 Rand, it's a 1.4% premium to the 30-day volume-weighted average price. Now, that is quite a thing. The spot price on the day that the book build results were announced was at just over 59 Rand. It was around 59.30 Rand. So we do at least have a scenario where the price is a small discount to spot, but it is a 1.4% premium to the 30-day VWAP because the share price has been doing quite well. And this just shows you that institutional investors are willing to support the best of the REITs, and certainly Hyprop would be considered among the better names. You might be wondering what they are planning to use the money for, and at least we are in a market where Hyprop actually has to tell investors, or at least give them some idea of what the money will be used for. Believe me, I've seen periods on the JSE where REITs are just raising money out of nowhere without even telling people what it's for. That's when you know things are getting a little bit too hot. But at Hyprop, what do they want to do? Well, they want to do solar and battery energy storage system projects at Canal Walk and Somerset Mall. And in Europe, they have flagged an extension at a property in Croatia. They are also looking more generically at new acquisition and expansion opportunities in Eastern Europe as well, in addition to their previously announced acquisition. So some interesting stuff at Hyprop, looking to allocate capital both locally and in Eastern Europe, and they got very strong support from the market here. I wasn't surprised to see it, and this is exactly why the REIT sector does well on the JSE. The thing to be careful of, because the REIT sector can also disappoint you, is that when you see funds coming through with capital raises that are very generic, and especially when you see the tier 2, not as successful REITs easily raising hundreds of millions of rands in a single day, then you've got to worry about where we are in the cycle. But for now, I have REITs as one of my biggest exposures in my tax-free savings account because obviously I lock in that dividend without paying any tax on it. And in general, I just feel like they offer compelling value, particularly compared to something like buy-to-let investing, which generally speaking, in my opinion, is a really, really tough way to actually try and build wealth. Because when you're buying a REIT, you don't have to worry about so many of the other issues that come with property ownership. I'm talking about concentration risk, for example, because REITs own wide portfolios, whereas a buy-to-let is literally one property. Other stuff like chasing a tenant to get your money. Obviously, that's the REIT's job, not yours. And then liquidity. If something changes in your life, you just press a button and you sell your REIT shares. Good luck trying to sell your house or your apartment on short notice. And interestingly enough, to finish off, I ran a poll in Bites recently where I asked readers their preference on REITs versus buy-to-let. 49% of respondents said REITs only, 24% said I have both, 13% said no thank you, property is not for me, and only 8% said, well, I'll only do buy-to-let. So I was encouraged. Obviously, this audience is very market savvy. That's why they read Ghost Mail in the first place and why you are listening to this podcast. But I was encouraged to see that people do understand the opportunity that REITs bring. That's it for this episode. As I said at the beginning, be sure to subscribe on YouTube or add it to your subscriptions on Apple Podcasts or Spotify, wherever it is that you would prefer to listen to the Ghost Bites podcast. And of course, make sure that you are reading it every day in Ghost Mail, because that is where you will get the news first. And that is also where you will get all the details, including the nibbles and directors' dealings, as opposed to the highlights reel that I cover in this podcast. Good luck in the markets. I'll be back soon.